I'm going to show you guys an example of high risk and low risk trading. So this is all to do with entries. Now I'm on the diagram. I've got something drawn up for you right now. Let's just say price is dropping. As you can see, it was making lower lows and lower highs, right? Lower lows again, but then now price is broken up to the top side. I'm gonna quickly break down to you guys what a high risk entry is. So what a high risk entry is, let's just say there is a down close candle in here. When price comes back down to mitigate this down close candle, this is a high risk entry only because there's nothing that's kind of telling you right now that apart from the fact that this high has been broken, that this is gonna hold. So although this is what validates the down close candle if they go and break the high, it's a high risk mitigation because easily, and you've seen a number of times, price could easily drop beneath this and continue doing its downtrend, something like that. That's what makes this high risk. Sometimes as well, this low here might be as low as the other one. Yeah, it might be two equal lows. This also becomes a high risk entry. There's nothing else telling you apart from this break of this high that price is going to go higher. That is high risk. At this level, there's still nothing wrong with getting an entry here. Don't forget, you're testing this out. You're going to back test everything we're speaking about today on your demo account. That's what you're going to do. You're going to be doing it on your demo account. And once you get confident, whenever you are ready, then you can go ahead and do your live trading if you want to do that. This is a high risk level. And so technically there's still nothing wrong with this because what validates the down close candle is that it's not only broken above this down close candle over here, but it's also violated market structure, broken the high. When these highs are being protected, they're no longer being protected. So this is a high risk entry. And so generally what you would do, anywhere within this down close candle is a good point for an entry. And with a stop loss beneath this down close candle here. Because technically, if they violate this level, then you were wrong. You know, instantly. That's why you don't be buying above a discount because they can drop deeper into a discount and then they can push up higher. Then you was right with the direction, but you just had the wrong timing and you was in too early. And so technically, you're going to be putting your stop loss beneath this level, and anywhere within this down close candle, you're going to be looking for an entry to buy. Although you might be in early, this is still a high risk trade and it's still a great trade, but it's just high risk. When it comes to the low risk setup now, if you are fortunate enough for the market to provide you with a low risk setup, you can enter that setup with more confidence. Why? Because now, check this out. Price has responded off of this down close candle and is then gone forth to break market structure to the upside again. So now it's violated a high. Now you can see that price was being drawn after mitigation was being drawn to run these buy stops up here. Didn't do it properly, but you know what I mean, these buy stops up here. So that means the moment they return back down to this down close candle now, whichever one is in here, the moment they return back down to this one, this becomes the low risk mitigation. It's the low risk mitigation. This was the high risk mitigation. You know, when it mitigated this one. Now this is the low risk mitigation. And so this becomes the higher probability setup. Low risk setup is the same thing as a high probability setup. And so in other words, what happens is because market is now respected this down close candle, you are expecting them to respect this down close candle too. And so this is technically where you want to be entering anywhere within this down close candle for an entry with a stop loss beneath this level. And then this is all you want to see. You want to see them run these highs. This is going to be your first point of taking partials, or this could be the end of your trade. On a smaller time frame, you're going to see all of this. You're going to see this, that. Oh, that again, you're going to see all of that, and you can use these points as reference points to take partials if you wanted to, and you can collapse the whole position here if you wanted to. Also, what you want to see then is you want to see price expand higher again, run that buy side liquidity, protecting these lows again, and this is just becomes another down close candle in here, protecting these lows again and running out the buy side liquidity. So that's the low risk setup, and this is the high risk setup. There's nothing wrong with going for both of these. This one just provides you with a bit more confidence, like you feel more at ease at this one, only because price has already respected a down close candle. One thing I always tell my mentees, look, if you miss the high risk, be patient. There's no need chasing the market. If you've missed this move, there are going to be opportunities to enter along these ways. This is not what this video is about. This is more so getting you, to grips with the basics of Forex with a smart money and institutional twist. There are going to be opportunities to buy price in here, but ultimately you want to be buying when price is at a discount, and you want to be offloading the moment price gets into that premium price. This is what you want to be looking for on your charts. These high risk and low risk setups. Some people like to wait to see this one play out and then catch this one. Others are a bit more risky and they like to jump in at this one. So just bear this in mind whenever you're looking at the trades. And don't forget, you're always going for some kind of liquidity. The biggest tips I can give in Forex is always trade towards the money. This is why I have a TTTM jumper on right now. It literally stands for trade towards the money. That's what it stands for, trade towards the money. The moment I started trading towards the money, my whole trading changed. My whole trading journey changed. I started winning more trades, being more profitable, and my return was a lot better. When I was doing that retail constant trading, I was winning and losing, winning and losing. The moment I switched to trading towards the money, everything changed. This is why you guys are called the liquidity gang, because we go for that liquidity and we trade towards the money, and we keep it as simple as that. And this is exactly the same for a downtrend. So I'm just going to show it to you again. So now, look, now to do it the opposite way, let's just say price is making low lows and lower highs. We get a break of these lows. You see this low was taken out now? That low was taken out. Then we get a retracement into the up close candle that ran this liquidity to the left. You would have seen some kind of up close candle in here. It goes to mitigate that, and then it breaks again. Don't forget, this is the high risk setup. Up close candle was validated because it violated structure, all of that. It came back up again here with another up close candle. This was the high risk setup, like I said. When price returns back to this up close candle, mitigates at this level. Don't forget, stop losses above the institutional candle. This is where your stop loss is going to be. Stop loss is going to be. This is where you want to be getting an entry to then run the money down here, and there will be another institutional candle right here. So what they would have done in this level here is this: they would have generated liquidity, run it, and drop beneath, come up mitigated, and then dropped again. This is what you would have seen in this level over here. That's what you would have seen. So all of that, boom, boom. This up close candle here mitigates this one and then breaks structure again. That means this becomes the low risk setup, or the low risk mitigation, or the high probability trade. And then this is where you'll be looking to catch an entry and a dropping. Most of the volume is going to be at 50%. So you might want to have an entry here and an entry at 50%. Some people like to do that too. Or some people like to wait, because if they enter from here and the stop loss is here, they have a better return compared to if you entered here and has stop loss up here. Your stop loss will be a lot smaller. You can make a lot more from your trading, and we're going to go into that too. This becomes the lowest setup, and you run that liquidity. You run that here. This is where you offload your position, and the price here was doing higher highs and higher lows. You might want to use some of these targets as reference points to scale off your position too. Look, I hope you guys are loving my diagram example. I just downloaded this, and I love it. I literally love it. I'm going to be using this a lot more. This is what we're going to do. We're going to go to right here, the 29th of September. I'm going to show you. You see how on a daily time frame, it just looks like one candlestick and then one candlestick up, or two candlesticks up. I'm going to go down to like the 15-minute time frame or the 5-minute time frame to show you how you could have caught this from this level. Okay guys, so now I'm going to show you guys an example of low risk trading and high risk trading, and I'm going to throw in the risk to reward as well, just so you guys know what I mean. If you go to the left here, you're going to see this tool called the long position and short position. Just to give you guys a breakdown of what that is before I get into things, this is the long position tool, and then this is going to be your short position tool. This is how it's going to look like. So this is your long position tool, and this is your short position tool. What this basically means is it shows you your risk to reward. Let me just break down these numbers for you guys so you guys understand what we're talking about. You can see right here where it's got these numbers here. This is basically saying your stop loss, which is this red box, is 10 pips. Don't forget, you always forget that very last digit. Whenever price is in your green zone, it basically just shows that you are in profit. And so when we get to the very top here, it says 46. That means this is a 46 pip move. This number here, the very bottom, you don't need to be concerned about this top line. The bottom line shows a 4.48. That means you can potentially win 4.5% on your account. And then here would be your account balance. So here, I just quickly changed the account balance to 10 grand. So let's just say your account balance was 10 grand. Basically what this number shows, if I zoom in, what this shows is that if you had a £10,000 account, if you lost this trade, you go down to £9,900, basically, which is 1%. And if you won this trade, you will go up to $10,448. So I meant to say dollars, it's not pounds, it's dollars. So let's just use pounds for now. From 10,000, you would lose £100, which is 1% on your account, or you could gain 4.5%, which is basically 10,500. When I double click into it now, you can see all it's saying is that my account size is $10,000. Let's just say it was pounds, doesn't really matter. You need to worry about what you're risking, which is 1%. You are risking 1% on your account. And so that's why if you lose this trade, you would lose £100. And then if you won, you would win £448, which is 4.48% on your account. Same thing on the sell side. Red box is your sell zone. Green box is wherever you're on profit buy. You can see your stop loss in pips is 5 pips. You're going for a 55 pip move. Your risk to reward ratio this time is 10.73% because your stop loss is a lot smaller. And when you have a smaller stop loss, you can use a bigger lot size. If I expanded this higher, you can see, just look at this number here. My risk reward drops and my amount I can gain drops, because if my stop loss is bigger, I can only use a smaller lot size. So let me expand the stop loss. You can see that drops now to a 5 0.6% return, and you can see my money that I get if I won this trade is a lot smaller. There's apps like Steamu that allow you to plug in your information and they literally tell you what stop loss you should use. Now, going back to low risk and high risk trading, I showed you guys that we were at a swing low on the 29th of September. And so this is that swing low. You can see at the bottom, you can see it says 29th of September right beneath where my cursor is. I'll put these back on just in case. There we go, right beneath where my cursor is. You can see it says the 29th of September. And what do we get? So we get a last down close candle from the high to the low. So this is our last down close candle. It runs out liquidity beneath this level over here. All that money that was resting beneath here. Then price traded high, but it never beat the high. So in other words, you're still thinking bearish until this high is beaten. Eventually what happens here, let me quickly bring this out for you guys so you guys can see it. From this level, this low, we break higher. You can see, so we never broke higher here. This was technically like equal highs. We never broke higher there, but we broke higher the moment it traded above this down close candle. Traded beyond it here, and then we retraced. So technically, this is what you would have done. Let's just say there would have been someone looking to enter from the open. So let me show you the difference now. And so they would have had a stop loss of roughly about 30 pips, for example, right? From the open. That's if you entered from the open, by the way. If you entered from the open, and then you would have targeted these highs over here. Boom. Boom, this is the high with the target because it is a high. And especially above all this consolidation, you want to be taking money above this high. And so you can see basically this high here, you could have targeted more because you know there's going to be stop losses above here. But let's just say you target this high. This then would have been a 1 to 3 risk to reward. As you can see, 1 to 3 risk to reward. It says 3.66 down here. You would have had a 30 pip stop loss and you would have been going for, let's just say 100 pips to run out the money above here and all these lows. Consolidation was a giveaway that price wanted to get up here. So don't forget, that's one individual. That's one individual. So let's move this guy to the left. Cool. And then there would have been the person who would have entered roughly about 50% of this institutional candle. So I'm going to use the Fibonacci tool to mark up my 50%. Altered this so it shows only 50%. And the 0, 1, and 50%. So now you can see it here, 50% is right here. If you had waited for 50%, so this is what I mean by better risk reward, because some people, they don't understand that you can get a better return if you wait for a bit longer sometimes. Sometimes it might not get down there. So once again, you're going for the same place. Your stop loss is going to be at that same level. So now look at the difference. I'm going to expand this guy out to the left so you can see it a bit clearer. This person had a 30 pip stop loss and they were going for a 113 pip move, and which altogether it was a 1 to 3.8 risk to reward. So that basically means every 30 pips, you're going to be gaining roughly about 1% in your account. Person B went for 50%, had a 15 pip stop loss, and was going for 128 pips. So in other words, they had a little bit more pips, they had a smaller stop loss, but look at this, look at the difference. Their risk to reward is at 8.82% return on your account. This person will potentially have a 3.8% return on their account, and this person will have a 8.82% return on their account because their stop loss is smaller. This person, if they lost, they would have lost £100. So their account would have gone from £10,000 to 9,900. This person here would have lost £100 still. So you would have lost the same amount of money, but you would have gained a lot more. So instead of gaining £379, I have moved this around a bit, so that's why the figures have changed. This person would have gained £882 in their account. So this is why risk to reward is vitally important. This is all from the person who's doing the high risk setup, going for the high risk trade. This is why pips aren't as important. It's all about your risk to reward. That was the high risk setup. Now we're going to look at the low risk setup. This down close candle came back down to mitigate this one. Now you're looking at price coming down to this candlestick, to this one over here. You want to see price expand away and return back down to it. And I've just put on a replay mode I just had to cut off some other stuff just so you guys I can play the actual thing out for you so you guys see what actually happened. I was in this trade as well. I'll see if I can find a screenshot for you guys, but I was in this trade as well. But anyway, you see this here when price expanded above again. So you can see here. Can you bring out this tool? Price expanded back above this up close candle, beating this high over here, as you can see. So in other words, price is making higher highs, higher lows, higher high again. When price returned back down to the institutional candle, this is where you wanted to be a buyer. And then look at this, check this out, boom. If I then draw up 50% of this down close candle, 50%. So like I said, some people enter at the open, some people can enter at 50%. Look at this. If I had a long position here, from 50%, and I had a stop loss either at these lows or beneath one of these lows over here, and then you targeted the same place, let's say this high over here, you still would have had a decent return on your investment. You would have had a 13% return if price gets up to that level. So don't forget, this is the low risk setup. The first down close candle, we break above, we retrace back into it. It was a very deep retracement. Normally you don't want to see it retrace this deep, but we expand again. And then we get that second return for a low risk mitigation. There's your entry, and then you target the money. You can target every single one of these highs. There's inefficiencies down here you can target too. Well, you can target even higher than this. This is the very low of the swing low. If you believe price is retracing from here, then this is the very low of the swing low. And as you can see, this is just a normal market reversal too. Now let's just see how we fare up. Let's gonna hit play on this. So let's just stop that there and hit play now. So basically, this is what we're looking at. Let's go. Let's just hold it down like this for now. Look at that. You see that, family? Right here. It would have taken you, I don't know how many days this was. So from this, the lower setup to when they run the high, that was like roughly what? Just 2 days? Roughly 2 days of trading? You can wait a whole 30 days for a paycheck, but you can't sit down on your cheeks and wait for 2 days for a trade to play out. So the high risk setup would have survived, the low risk setup would have survived. For example, let's just say even if you had taken partials along the way and price came back down to stop you out, price was still trading within this down close candle here. And so you could have entered again and even caught more. Do you understand? And these are some big pips, by the way. So even from this level to this high, that's 80 pips. Amazing amount of pips. They fell back down again one more time for more mitigation, and then they took off again. So that for you guys is low risk trading and high risk trading. Okay, family, and so now the final thing I want to share with you guys in this whole beginner forex full training, where do you want to take your partials at? Where do you want to close off your trade? What should be your TP? We are on a higher time frame. You are going to get different reference points or TP points on lower time frames, but I'm going to keep it simple with you guys for now and show you guys, well, this is where most likely you'll be taking your partials at. And so we're going to be using the daily time frame as a reference point. This is not to force you guys into trading the way I trade. This is just to give you an insight with a smart money institutional twist on forex trading for beginners. What I've seen so far online is just forex trading for beginners, but there's a lot of retail concepts. So this is why I've decided to give you guys this with a smart money and institutional vibe. When it comes to taking partial profits, this was a big thing for me. Where on earth do you take profits? What on earth is going on? Should I take profits here at this structure point? Take partials or take profit where there are willing participants who want to continue your trade. Think about that. Let's just run it back. You see the price produces a high, after consolidating produces a high, retraces back. You have to be thinking about, so where do you want to take partial profits? You're going to be taking partial profits at liquidity points. This is why we are called liquidity gang. I don't know if you can see it. It says liquidity gang right there. We trade towards the money. We take that liquidity. Technically, you want to be looking for reversal signs at these highs, and then you want to be targeting some form of liquidity. So let me quickly zoom in a bit more. So you see this high, you would have got a reversal sign here. Under every single one of these daily lows, every single one of them, there's going to be money beneath every single one of those daily lows. There's going to be liquidity beneath these lows over here. They've run out all that liquidity to the left hand side that they wanted to run with this push up, and now look, there's liquidity beneath every single one of these lows. And so you can even use these daily lows as reference points to take partial profits to close off your whole position. You can do that. And ultimately, if you do want to swing trade, you want to be looking at swing points. So these swing lows over here, swing lows, this is what you want to be looking at. You want to take partial profits or close off the full thing where there are willing participants to continue your trade. So when price was dropped beneath this daily candlestick here, this low of this daily candlestick, this one right here. So let me think of this. So this arrow tool, there we go, this daily candlestick right here. When price ran beneath that, there would have been willing participants to sell. That could have been a point of interest where you could have taken off some profit. And when I say taking partials, for those that don't know, is if you have a full position, let's just say you are trading a one lot size. If you wanted to close off partials, you will close off 80% of that trade. So in your MT4, you literally press close, and then when you press close, it will show 1.00, which represents one lot size. You will change that figure to 0.80 for 80%, 0.50 for 50%, whatever you're comfortable with, and you will press close. It will close off part of that position, and you can let the rest do the hard work. And so ultimately, I've said this in the video already, but I'm going to repeat one more time, is that when it gets to these levels, you see how I never got there here, but when it gets to these levels, let me expand that a bit more. When when it gets to this level here, this is where you want to be closing off your position or taking partial profits. If you're looking at the daily time frame, if you're looking to swing trade, you don't take partials out of thin air. You have to be thinking, where are the large funds, where are the banks willing to offload their positions at highs and lows? So if this is a low, this is most likely where they're going to offload their sells at. So you want to be offloading your position at those levels, because there's going to be willing participants to sell in this level here. And so your sell should be offloaded to them. And really and truly, they get the nasty work. They get a little short piece of the pie and the price reverses on them. Okay, but you're done by then. You're good by then. And it's the same thing as if you was going in an uptrend. Let's just say we're using this as an uptrend. What you'd be looking to do is, if this was an uptrend now, a reversal sign in this level, you can either target a lower time frame, lower high, or you can look at these highs. You can see these highs here. You target those highs. And that's why when you get a small consolidation like this, when market's going sideways, don't need to panic. If you are really nervous about it, what I normally suggest is take partial at this level, let the rest do the hard work. That's what you should kind of be thinking about for TPs. Where are the buy stops in the market? Where are the sell stops in the market? If I am bullish, I want to be offloading where the buy stops are. If I am bearish, I want to be offloading where the sell stops are. So keep that in mind, family, and that will help you with where you take TPs. That is the Beginner Forex full training video with a smart money and an institutional twist. There's going to be tons of cards attached to this video that you can watch to go and further your learning. So watch those videos after this one if you really want to push forward your trading. Blessed training, you guys. Have a good one. Peace.